All right. Hello again, everybody. This is Mike Rixey. I am the lead options instructor for NetPicks, and this is our weekly options recap. I wanted to jump on here today, walk you through some trades that we just closed out this morning. We've been talking quite a bit here lately about our overnight pop trades. They've been doing really well for us. I want to walk you through a handful of those trades that we closed out again here today. We opened them up yesterday afternoon. We closed them out first thing this morning. I had some nice winners, so I'll recap those trades. We'll also take a look at some of the markets that are jumping out at us going into next week. We do have a long holiday weekend here. Markets are closed on Monday. Makes it a little tricky initiating new trades going into a long holiday weekend. Just gives it another day for a big event to happen or a headline to hit. So it makes it a little tricky, but we'll take a look at some of the markets that are jumping out at us here today. So as always, if you have any questions, feel free to post those here into the chat. If you are watching the recording on Facebook or YouTube, you can always post a comment on those videos or email me directly, mike@netpicks.com. More than willing to get back with you. All right, so let's start out by talking about market big picture, and then we'll transition over to the overnight pop trades. If we take a look at this daily chart of SPY, I always like to start out with this chart because it gives you a glimpse into big picture, and it helps shape how aggressive or conservative we want to be. Do I want to use more weekly or monthly options? Do I want to use more defined risk trades like a credit spread? Or am I looking at more aggressive directional trades with just long calls and long puts? A lot of that decision-making for me is based off of what I'm seeing on these big picture charts. If we take a look at the daily chart, no doubt about it, the bulls have been in complete control of this market, really going back into late fall of last year. We have seen very little selling pressure since, and market has basically been pinned up near the all-time highs. Any selling pressure that we have had has been bought up very quickly. And you can see on this daily chart, the little moves to the downside that we have had have tested key support levels. If we go back into January, we tested the 20-period moving averages, bounced off of those levels, went to highs. Back early February, we had the pullback into the 50-period moving averages, found support there, and like a trampoline effect, went right back to the upside and have just made new all-time highs again this week. So where does that leave us? Well, a couple things that we've been talking about here recently. First of all, the volume has been an absolute struggle, especially on these moves to the upside. Look at the volume down at the bottom. On these moves higher, it's been a struggle just to hit 45 million shares on a daily basis on SPY. That's extremely light volume. The only time that we reached 50 million shares over the past week and a half has been on the one down day that we had here earlier this week. Otherwise, it's been a very low volume grind to the upside. Markets don't need volume to move. We've talked about that previously. When you get into these low market environments, price action tends to favor the upside. And that is exactly what we are seeing here this week. When volume gets this light, it typically comes near the late stages of a move. I would not be surprised at all if we either consolidate here for another week or so, or even pull back. The boat is completely loaded on the bullish side. Everybody that wants to be bullish is already bullish. It's not a great place here to initiate new long trades because so many stocks are extended. You're chasing at this point. If you're already into bullish trades, that's fine holding those. I have no issue there. It's just the risk reward does not favor getting aggressively bullish here with new trades. The odds actually favor a pause or a pullback. And I would love to see that before another wave to the upside. Everybody is expecting the S&P to hit 4,000. Here we are on SPX. We're sitting at 3920. We're only 80 points away from that key psychological level at 4,000. Everybody's expecting it to happen. If it's going to happen, I would expect a pullback here first. Where would I be looking at for a test of support? The 8 EMA, which is the pink line, is at 388.24. I'd love to see at the very minimum pull back to that level. And it's only a couple bucks away. It's really not even a deep pullback. That would be the first area that would catch my attention. If we break that level, a better area to move to would be the 20-period simple and exponential moving averages, which are down around 383. If those levels are tested, that would, in my opinion, provide a more reliable place for another push to the upside to start. If we don't get that pullback here over the next week or so, I just don't think there's going to be enough volume to give us that 80-point push from here. Of course, anything can happen. So we'll see what happens going into next week. So 392.28, that's the all-time high from earlier this week. That is our line in the sand on the upside. That's our near-term area of resistance. Above that, we're looking at 393 and 394 as the next areas that we'd look for price to stall out at. And then 388.22 and 383, those are the levels of support that I'm watching going into next week. Also, the ATR, the average true range down at the bottom, continues to head lower. We saw some stabilization here earlier this week, but now we are breaking down towards that four handle. They're trying to break that four handle. If the range continues to contract, it's going to make it more difficult for us to be active. It doesn't mean there won't be trade opportunities. There will be. It's just going to be more active on an intraday basis because you're not getting those back and forth moves. I want to see this ATR start to uptick from here and head back above 5. In order for that to happen, we will need to see some selling pressure. Has to happen. The VIX is also barely hanging on to the 20 handle. It's been above 20 now for almost a year. That's a very historic move on the VIX. We don't typically see the VIX at that type of a reading for this long. I wouldn't be surprised at all if this market decides to bounce into the close. If we close up near the highs, I would not be surprised if the VIX tries to make a run down and break 20. I don't want to see it happen, but it's Friday afternoon. We've seen so many Friday rallies going into the close. So we'll watch that very closely. We do not want to see that VIX start to head lower from here. Don't want to see it down in the low to mid-teens. We've been there in the past, and we know how slow markets can get when the VIX starts to contract like that. So we'll look for the VIX to start to bounce here going into next week as well. Let's take a look at the trades that we closed out here this morning. We have been cautiously bearish here this week and had some questions come in from people on why I'm bearish. Well, first things first, I am not expecting the market to crash. I don't need it to crash. What we are looking to do is to put on some very quick trades that would benefit from a period of consolidation or a pullback from occurring. I didn't want to just continue to chase this move to the upside. So what we did yesterday afternoon, we like to put on these overnight pop trades, especially Thursday afternoon going into Friday, because we have so many names that have weekly options that are expiring on Fridays. SPY is one of those products that has Monday and Wednesday expirations as well. So we have been taking advantage of those on SPY. But here yesterday afternoon, we had an abundance of opportunity because we have so many products with weekly options expiring here today. I love these trades because even though they're not big home run profit potential type trades, they help generate some consistent income for us. Now, going back to Friday's recap video last week, we closed out of a couple of partial losses last week. And I talked about how the losses they're going to happen. It's part of any system. But the key there is to keep the big picture in mind because we know long-term, even with those losses, it's no reason to throw this trade out. It's no reason to, completely abandon it. It was just a rough end of the week last week. We just didn't get the movement that we were looking for. We still closed the week positive last week. And here this week, we have recovered very quickly. So here's what we've done. IWM is the Russell 2000 ETF. The Russell 2000 has been on an absolute tear. The small caps have been a big market leader over the past couple of months. As a result, it's very, very overbought. And we started to see some signs of IWM pulling back over the past couple of days. We haven't seen anything significant, but has definitely tried selling off a couple of different times. What we did yesterday afternoon, and let me go ahead and get my camera off so that way you guys can see my platform better here. There we go. Try to make it as big as I can for you. So what we did on IWM is we came in and we were utilizing the February 12 options, the options that are expiring today. And we came in and we sold the 227.5, 229 call spread. All that means is I'm selling the 227.5 call to open up the trade, and I'm buying the 229 call at the same time. I'm trading two options at the same time to define my risk. I want to know what my worst possible case scenario would be if I am dead wrong and we don't get the directional move in our favor. So we opened this trade yesterday afternoon. We opened it up for 50 cents. We collected 50 cents or $50 per spread, and we were risking $100 of our capital. So very reasonable trade, right around risk 2 to make 1, not tying up a ton of capital. If you've got a bigger account size, IWM is a very liquid product. You can take this trade with 40, 50, 60 spreads and not have a problem getting filled. You take this trade with 10 spreads yesterday, you got $1,000 of risk. So very reasonable for a wide range of account sizes. The $50 per spread was our maximum profit potential, but the only way that we are going to be able to book that full profit is if we hold to the close here today. I wasn't looking to do that. I wanted to close this trade out as quickly as possible this morning. Well, fortunately, we did get the lower open. It did not last long this morning, but we did get the lower open. And within the first 5 minutes, we were able to close out of this trade. And we bought this spread back for 13 cents. Okay, so we bought it back for $13 per spread. It gave me a $37 profit per spread, $111 of profit if you're using the risk parameters that we outline, risking $500 per trade. That's a number that's very reasonable for most retail account sizes. So on the surface, it doesn't look like a big profit, right? That was a 37% return on our capital, and we were in and out in less than 24 hours. We entered this trade around 3:30 Eastern time yesterday afternoon, and we closed it out about 9:35 Eastern this morning. We are in and out generating a nice little supplemental income here this week. If you put it on 10 times, you got $370 of profit overnight. Okay, these add up very, very quickly. Really great trade. Now, had I held, I'd still be in a profitable position. The spread is trading for 21 cents, but what I didn't want to do, because volume is so light, it doesn't take much to get this market to whip around. I didn't want to hold this trade into this afternoon and run the risk of having it go from a nice profit to a loss. And that can happen very quickly on expiration day. So we ended up closing the spread out for 13 cents earlier this morning, right after the open. Another trade that we put on here yesterday afternoon was on First Solar, symbol FSLR. Again, utilizing the options that expire today. The nice part about Thursday into Friday is a lot of these individual stocks have options expiring on Friday. So not only do we have the index ETFs that are available to us, but we also have the individual stocks at the end of the week as well. So on First Solar, we came in and we sold the 100-102 call spread, meaning I'm selling the 100 call and I am buying the 102 call at the same time. This is a neutral to bearish position. I make money on First Solar as long as price stays below 100. I don't need a big move lower. If it does make a big move lower, perfect. We're going to make money even faster. But all I need is for price to stay below 100. We collected 50 cents or $50 per spread to put this trade on it, tied up $150 of our capital here yesterday afternoon. Now, first thing this morning, First Solar opened up around $97 or so. That's where we were trading around the low right after the open. We ended up closing this trade out first thing this morning for 25 cents. We booked a $25 profit. It's a 17% return on our capital overnight. And here's why I love this trade. Look at the price of First Solar. We sold off for maybe 15 minutes this morning. It did not last long, and the markets decided to bounce. So we did not get the move to the downside, just like IWM. We didn't get the big move lower that we were hoping for, but we were still able to book a profit. Okay, we were still able to book a 17% return overnight. I love the credit spreads because they are more forgiving. Had I just bought an outright put option on either IWM or First Solar, I would have been in trouble here today because we didn't get the big directional move lower, and the time decay would have taken any profit potential that I would have had. But the credit spreads allowed me to book profits this morning. Now, had you held on, you could still be in the trade on First Solar. It's currently trading for 52 cents. So you're looking at a break-even trade at this point if you held. But on these trades, I like to close them out as quickly as possible on expiration day. So we did take the profit on First Solar first thing this morning. We did talk about another trade on SPY that we took earlier in the week. Tuesday into Wednesday expiration on SPY. And what we did there is we sold a $2 call spread. I talked about this in our midweek update on Wednesday, but we closed out of a 16% return here midweek on SPY. So on the week, we have taken 3 overnight pop trades. All 3 were winning trades. We had a 16% return on SPY, a 37% return on IWM, and a 17% return on First Solar. Okay, when you start to add these up, they don't take a ton of time to manage. We put them on the afternoon before expiration. We take them off the morning of expiration day, ideally. There are certain times where we have to hold longer, just depending on market conditions. But in a lot of cases, we're closing these trades out very, very quickly on expiration day. It's just a really nice supplement to what a lot of other traders are doing. Maybe you're day trading. Maybe you're looking to take longer term swing trades. This can be a great complement because now I've got longer term positions on that I'm looking to hold for a period of a few weeks. During that time, if I can generate a more active source of income from the overnight pop trades, it works out perfectly. Those approaches complement each other really well. Okay, so that's what we did there on the overnight trades. And we'll continue to look at these here going into next week. We could take an overnight trade this afternoon going into Tuesday's expiration because Monday is a holiday. Markets are closed on Monday. We don't have that Monday expiration next week on SPY. So it makes it a little bit tricky. Again, like I said earlier, when you have a long holiday weekend like that, when markets are closed on Monday, it just gives another day for an unforeseen event taking place. Right? I mean, you take a look at the last year and what seemed a stretch has become the norm, right? So anything can happen. So I'm not opposed to taking a trade this afternoon going into Tuesday's expiration. You just want to be cautious. Keep the risk small. If you're able to cut the risk, maybe take a trade with half of your normal position size. That could be something that's doable. I just don't want to get ultra aggressive going into a long holiday weekend. All right, so let's go ahead and take a look. Let's go ahead and take a look at SPY. Let's go over to the 195-minute chart. This is one of the primary timeframes that I use to base my entry points off of. I like to use the 195-minute chart as well as the 130-minute chart. Those are the two that are my primary focus. They speed things up a little bit without getting caught up in the chop that can happen with an hourly chart or a 30-minute chart. Just it gives us a really nice glimpse into current conditions. And you can see here on the 195-minute, just like we talked about on the daily chart, price has been super solid on the upside. We're very overbought in the near term, but price on any type of selling that we've had this week, notice how price has found support right on top of that blue line. That blue line is the 8-period exponential moving average. We have not been able to break that level at all. Until that level breaks, I don't want to get aggressive on the downside just yet. I'm not looking to pick the top. If you want to lean a little bit bearish here, I'm not opposed to it. Just utilize a different strategy other than a long put. Don't look to buy any type of long puts here on SPY until we break that 8 EMA at a minimum. That level is currently sitting right around 390-ish or so. If you want to sell an out of the money call spread, I am perfectly fine with that. You're okay there because now you give yourself 5 ways of making money on the trade. It provides a more forgiving type trade. So I'm okay there. That's why we sold the call spread here yesterday afternoon going into expiration today. I'm fine with that. It's just on a long call or long put position, those trades are very time sensitive. So I'm not looking to get aggressive here on SPY. If anything, selling it out of the money call spread, certainly something that is reasonable going into next week. Now, all of that we just talked about on SPY holds true for IWM and the NASDAQ as well. IWM is the Russell 2000 ETF. And let's go ahead and take a look here. The 8 EMA is currently sitting at 225.99. That is the first level that we need to see broken here. We tried to break it here earlier this week. Found support right there, kind of bounced off of that level. So until that level breaks, again, no long put positions here that I'm looking at as of yet. A short call spread, selling it out of the money call spread, I'm okay there. So we'll revisit this one. If we do start to get some selling next week, IWM is going to be at the top of my to-do list because it's the most overbought index product in my opinion. I want to get aggressive as soon as price action confirms. So not doing anything here on IWM today, other than closing out that overnight pop trade like we just talked about. Just staying flat there going into next week. QQQ, the NASDAQ ETF, very similar story. We just continue to hover just above the 8 EMA. That has been a rock solid support level for all of the index products. until that level breaks, we're just going to continue to see this slow, methodical grind to the upside. So nothing to do here either on QQQ. We are just going to, we are going to stay on the sidelines until we start to get confirmation of a pullback. Now, we talked about a couple of different trades here over the past week or so. I wanted to give a quick update on those. SLV, if we go back into last week, this is the silver ETF, and we talked about a potential long call option here on SLV. Silver, it's been hanging in there. It's up 1% here today, which is nice. The problem with silver has been just the chop that has kicked in. We have not been able to break away from this 25, between 25 and 26 has been where, well, actually I can take that closer. 25 to 25 and a half has been just a very difficult range to break out of. I still like silver on the upside. We're still in the long call position. I've got a March position on out in SLV. Could you initiate a new long trade here? Sure. I wouldn't have a problem with it because we are still right around our entry point. Our entry point initially was this these two blue plus signs right here. That indicates my entry point, and that prints because our trend strength histogram down at the bottom went from red to blue, indicating bullish momentum taking over. Price action so far has stayed above the AEMA. So right now we are still bullish, but we want to see this 25 to 25.50 range break to the upside very quickly. Ideally, early next week, it would be great to see this thing start to break out. So if you wanted to initiate a new trade here on SLV, I would do so. Let's go over to the trade page here. I would do so over in the March options. The March monthly options, those are the ones with 35 days left to expiration. You can take a look either at the 25 calls, or you can go to the 24.5 calls. Either one, very liquid. You can see the volume and open interest on those options are very active. You're not going to have any problem getting filled. In fact, the bid-ask spreads here are between 1 and 2 pennies wide. Very tight markets. This is a very easy product to trade and get quick fills on. So let's just say you went with the 24.5 call. You're talking about $164 per contract at this point. So very reasonable trade regardless of account size. And this would be, it would be a straight bullish trade. We don't get the benefit of having multiple ways of making money like a credit spread. This is a pure bullish trade where we want SLV to move higher, and the quicker the better going into the next couple of weeks. So that is definitely a trade still on my radar. I still have the trade on. If you wanted to add it as a new position here, perfectly fine with that approach. If you do buy the long call, I should have pointed this out. Our initial target is a 100% return. We're looking to double our money on this, and our risk, our stop would be at 50% of the cost of the option. So let's just say you get filled at $1.60, you'd be using an 80-cent stop there. That's how we would manage the trade on SLV. Another one that we talked about here over the past week is PayPal. And we talked about this as potentially being a trade candidate for us. This again is the 195-minute chart. We are very overbought. It's been an incredible move higher here. Very overbought. What do we quantify the overbought condition by? Take a look at our pulse histogram down at the bottom. We've got these 3 bars plotting. Those yellow bars represent price being between a 1 and a 2 standard deviation channel move on the upside. It's extreme. It doesn't mean price can't head higher from here. It just means it's not statistically probable. In all likelihood, when you start to see those yellow bars, it typically leads to either a period of consolidation or a reversal in the other direction. We talked about this earlier this week. If we go back to October, we had some yellow bars there on the pulse. Look what happened on the upside. We were overbought. Took a couple of days. It didn't happen immediately, but we started to see some chop kick in, and then eventually we rolled over to the downside. Had a nice tradable move on the downside. We then got yellow bars on the downside indicating an oversold condition. What happened? Price started to chop a bit, and we reversed back to the upside. It's a very repeatable pattern. Now, in the heat of the battle, I mean, you take a look and you're saying, all right, markets here are overbought. Do I really want to fight this trend? I've heard so often here over the past week or so, the trend is your friend. Guys, long-term, the trend is not your friend. Okay, I don't have a problem taking trades in the direction of the trend, but only if it's a part of your portfolio. My response to that comment is always, if everybody is doing the same thing, if everybody is just saying, hey, the trend is your friend, only trade in the direction of the trend. Why do 95% of traders fail long-term? Everybody does the same thing. right? If you're going to take trades in the direction of the trend, I am fine with that. And in a lot of cases, it will work out, but it's not the holy grail, right? You want to make sure that you are looking for trades in both directions over time. Okay. In the heat of the battle here on PayPal, you're saying, why would we ever try to fight this trend? Because we know we have hit an extreme here. And we know that anytime that we have seen yellow bars here over the past couple of months, it has led over the next couple of weeks to either a period of consolidation or a reversal in the other direction. That's why we talked earlier this week about selling an out-of-money call spread on PayPal. Now, it has not pulled back yet. If we go back in time, again, remember, those reversals, when we had those extremes on the pulse, those reversals didn't happen immediately. Sometimes it takes a couple of days. Sometimes it takes a week or so. With a credit spread, selling an out-of-the-money call spread like we did on PayPal, it's a neutral to bearish position. Ideally, we want the stock to move lower, but we don't need it to make a big move lower. As long as price action stays below the strike price of the option that we sold as part of the spread, we're okay. We don't care if the stock moves up, down, or sideways. As long as price stays below that short strike, we're okay. We also make money from time decay adding up and from volatility decreasing. So now we've got 5 ways of making money on the position. If you have not sold an out-of-the-money call spread on PayPal yet, it is still a candidate to consider because nothing has changed as far as our outlook goes. The only thing that's changed since Wednesday when we connected is overbought has just gotten even more overbought. So we still have that neutral to bearish outlook going into next week on PayPal. And then let's go over to Lyft. This is symbol LYFT. So this one has actually hit an even stronger extreme this week. Notice on our pulse indicator down at the bottom, not only do we have yellow bars there, but just over the last couple of days, we've actually seen green bars plot. The green bars will plot when we reach between a 2 and a 3 standard deviation move. Less than 1% of all occurrences are going to fall outside of this range on the upside. What that means is, statistically speaking, the odds favor either a period of consolidation here or a reversal to the downside. It doesn't mean I'm just going to come in and outright buy long puts here. It's just too aggressive. We haven't seen price action to confirm. If I'm going to get aggressive on the downside, I want to first see that 8 EMA break. We haven't seen that happen. Price is still above that blue line. If I want to be a little bit more conservative and lean bearish, I can come in and sell an out-of-the-money call spread. And that's what we're going to take a look at doing here today. So let's jump over to the trade page. Take a look at the Lyft options. And we're going to stick with the March monthly options with 35 days left to expiration. Volume has been very, very light market wide. That does make it more difficult to get fills on trade. So I want to make sure that we are in an expiration cycle that has good volume and open interest. You're typically going to see the better liquidity in the monthly options. So we're going to stick with March. And let's go ahead and take a look at, let's start out with the 60 calls. They're about $3 out of the money. I'm going to go and right click on those 60 calls, go to sell, and we're going to go to vertical. Let me save that order down at the bottom. So we're going to sell a credit spread. And by default, it pops up an order down at the bottom where I am selling the 60 call and buying the 62.5 call at the same time. There's a $2.50 difference between those strike prices. The whole idea is I want to use a credit spread, but I want to make sure that I'm paying attention to my risk reward. Ideally, I want to be in a trade that's right around risk 2 or 3 to make 1. That's the typical range that we're looking for. To get to that range, I'm typically looking to sell a spread where I can collect between 30 and 40% of the width of the strikes. If there's a $2.50 difference between the strikes here, I want to collect between 75 cents and $1. This spread is currently trading for 77 cents. That meets my criteria. If I click on confirm and send, you'll see here that I would be risking 173 to make 77. I'm between risk 2 and 3 to make 1, right inside of the range that I just talked about. This is a neutral to bearish position. How do we make money? The ideal scenario is for Lyft to sell off. The faster it moves to the downside, the faster we will make money. If it doesn't move lower, we can still make money. We just need price to stay below 60.77. That's our break-even point here. So we've got about a $3.50 cushion here where price can move to the upside, move a direct against us, and I'm still okay. I'm not expecting a big move higher here because, again, we're already past a 2 standard deviation move on the upside. We're already very overbought. Any type of a move lower here, up, down, or sideways, as long as price is below 60.77, we make money. We also make money from time decay adding up and from volatility decreasing. So now I give myself 5 ways of making money over the next 35 days. My max profit is $77 per spread. My maximum risk is $173. Very reasonable trade. If I just come in and look at buying a long put option here on Lyft, let's just say I come in and buy an option that's slightly in the money. Let's say I look at the 60 put. We're talking about between $550 and $600 per contract. We're able to reduce that cost by more than half by using the out-of-the-money call spread. We have less risk. It's still a bearish position. Ideally, I still want the stock to move lower. We just give ourselves more ways of making money. It's a more forgiving trade. Now, in exchange for that, we do give up the home run profit potential. My max profit is $77 per spread. I'm not going to be able to make any more than that. Right? So that would be a trade candidate here for either this afternoon or even early next week. I don't think you have to rush into this thing. You know, with 35 days left to expiration, you could hold off to early next week if you wanted to. I wouldn't be opposed to that. How would we manage the trade? If we collect 77 cents, that's our max profit. But the only way I can book that entire profit is if I hold all the way to expiration. I don't really want to do that, because the risk starts to pick up the closer we get to expiration. So I want to close this spread out when I can go ahead and buy it back and keep between 50 and 75% of my max profit. So if I can buy this thing back for between 19 and 38 cents, that would be an acceptable range. I would create my closing order at 19 cents, and I would do that right after I put the position on. That way I can have a closing order working over the next 35 days. Anytime over that stretch, if the spread trades for 19 cents, my order will be executed and I can book the profit. So it's just I'm not going to say it's a stress-free trade, because we still have risk on the trade. It doesn't take a lot of time to track and manage this type of a position. All right. So that is Lyft going into next week. And we've got a lot of candidates, guys. If you start to go through your charts, I mean, you're going to see a lot of chart patterns that are very similar to this. A lot of overbought markets. Like I talked about earlier, not really an ideal scenario here. If you look at Lyft, is this an ideal spot to buy a long call? I mean, you go back to November of last year, we've basically seen this stock go from around $20 a share all the way up to almost 60. Not really an ideal spot here, risk reward wise, to go ahead and initiate a new long call. Do I want to buy long puts here? Not really interested there either, because price hasn't confirmed. We really haven't seen any type of sustainable weakness yet, right? That's why if you're just limited to buying calls and puts, this is going to be a tricky stretch until we start to see some two-way movement here, start to see some pullbacks. This is going to be a tricky stretch for just buying calls and puts. But if you start to implement those vertical spreads, now all of a sudden you give yourself way more flexibility for different types of markets. That's why you've been talking about those credit spreads so much here lately. If we start to see some two-way price action next week, we'll certainly shift our focus right back over to the long calls and long puts. We just need to see price action confirmed first. All right. So if you have any other questions on markets that I have not talked about here today, feel free to type those in. I'll do my best to take a look, give some opinion there. Otherwise, I am going to start wrapping it up for today. I'll wait to see if there's any questions, or if you post any type of symbol that we want to take a look at, go ahead and do that now. The plan for next week, I will be back on Wednesday for our midweek recap. We can certainly take a look at any markets you guys are interested in at that point. So as always, feel free to post those into the chat. So we'll take a look next week, see if we can get some additional overnight pop trades on. Keep in mind, markets are closed on Monday, so just be cautious with the risk here going into the close today, and then we'll pick things right back up on Tuesday next week. So if there's no questions or comments, I am going to wrap it up here for the day and for the week. Enjoy your long weekend, everybody, and I will talk to you hopefully next week on Wednesday.